Investors, hello! This is AI Crypto Insights channel. A few minutes of AI-powered insight into the market. Educational reference only, not investment advice. Today, we're parsing an institutional report from Goldman Sachs that asks a really huge question. What's the one thing that will finally convince big money to jump into crypto? Their answer? Well, it might surprise you.
Okay, so what's the big takeaway here from Goldman? They are arguing that the next massive wave of institutional money isn't going to be driven by the latest hype coin or some new piece of tech. No, it's going to be driven by something much more fundamental: clear, established rules of the road.
But if regulation is the key, what's the lock it's trying to open? You see, for years, the big financial players, we're talking the hedge funds, the pension funds, they've mostly been on the sidelines. They have a fiduciary duty, which means they have to protect their client's capital, and that means they can't just touch assets where the rules are all murky. And it turns out there's a very specific reason for their hesitation.
Goldman's analysts went directly to the source. They asked these institutions straight up, what's the number one thing holding you back? And you know what? It wasn't the wild price swings, or fears of hacks, or even the complexity of the tech. The answer was overwhelmingly clear. And here is the data to back it all up. A huge 35% of institutions point to regulatory uncertainty as their biggest hurdle. Now you combine that with the 32% who say that getting clarity would be the single biggest catalyst, and the picture becomes absolutely crystal clear. We're talking about the one thing holding back an ocean of capital.
But here's where the story gets really interesting. According to Goldman, that regulatory wall is starting to show some serious cracks. A major shift happening in Washington is creating a completely new environment for crypto in the US. It all starts with a political shift after the election, and that's leading to a complete leadership overhaul at the SEC. With a new chair, Paul Atkins at the helm, the agency's entire approach has changed. The old strategy of regulation by enforcement is out, and a new, stated policy goal is in: to actively promote the US crypto industry.
And this isn't just empty rhetoric, not at all. Congress is now actively drafting legislation to create a clear market structure. These aren't minor tweaks, they're foundational rules that will define everything from how tokenized real estate is treated to who's in charge, the SEC or the CFTC. This is the exact playbook institutions have been waiting for.
And we're not talking about some far-off future either. Goldman, along with another major player, Grayscale, believes there's a high probability of a bipartisan bill becoming law as early as the first half of 2026. This is the timeline that has the entire market holding its breath.
So, once these clearer rules are in place, what happens next? The entire conversation shifts. We move beyond just buying and selling Bitcoin, and capital can finally start flowing into applications that unlock the real, deeper potential of this technology.
Goldman highlights three key pillars for this future growth. First, tokenization. Think of taking a skyscraper or a priceless piece of art and representing fractional ownership of it on a blockchain, making it tradable 24/7. Second, DeFi, which is all about building entirely new, more efficient financial infrastructure from the ground up. And third, regulated stablecoins, which will act as the trusted digital dollars that make this entire new economy run smoothly and reliably.
So let's get to the bottom line. How much capital is already teetering on the edge, and just how big could the wave be once these regulatory floodgates finally swing open? Even with all the current uncertainty, the report shows that institutions have already dipped their toes in, with about 7% of their assets in crypto. But here's the real kicker. A massive 71% of those managers plan to increase their allocation. The demand is already there, coiled up and just waiting for the green light. And we can already see proof of this demand in the products that are regulated. Take the spot Bitcoin ETFs. They provided a familiar, safe entry point for investors. And in a really short amount of time, they've already attracted over $115 billion in assets. This was the proof of concept.
And the same story is playing out with Ethereum. The recently launched Ether ETFs are on a similar rocket trajectory, quickly blowing past $20 billion and proving that this model wasn't a fluke. It works for other major digital assets.
And perhaps most importantly, look at the plumbing of this new system. The regulated stablecoin market, which is basically the digital dollar backbone for all of this, has swelled to nearly $300 billion. This isn't speculative capital. This is the stable, liquid foundation that institutions need to operate at scale.
AI analyst verdict. The Goldman Sachs report concludes that regulatory clarity isn't just a contributing factor, but the primary catalyst poised to unlock the next significant wave of institutional capital into the digital asset ecosystem.
So the question on everyone's mind is the one on your screen. Just how much capital is waiting on the other side? Share your thoughts in comments. See you next episode.